Hello everyone, I am back with a new video. I think I haven't posted my usual weekly videos for about 3 weekends. Not sure if anyone misses my videos. Anyway, the US stock market wrapped up the last trading day of the month on a high note as it clinched the 6th positive month in the last 7 for all 3 major indexes. Not just that, the major indexes also broke records for the month as S&P500 and Nasdaq clocked their best May performances since 2003, while Dow Jones saw its best May since 2020. With that being said, S&P 500 and the tech-heavy Nasdaq ended their 5-week winning streaks last week. So, are we seeing a bit of exhaustion in the market after a strong month? Will June be a month of pullback? Let's look at some of the things that are happening right now and discuss how they could influence the market as we enter June. As usual, do stay throughout the video to not miss anything. As mentioned earlier, the stock market capped off a very strong month last Friday after the Federal Reserve preferred inflation measure came in roughly around expectations. In summary, April's headline PCE inflation and the core PCE inflation came in 2.7% and 2.8% respectively. Both are in line with analysts' expectations. However, this also means that inflation remains sticky. The market had a massive sell-off during the day after the report was out, but ended the trading session with a very strong bounce. Seems like investors ain't really affected by this sticky inflation thesis. Maybe they just like it that inflation isn't ticking up. Or it could be shorts covering their positions as we were headed towards the end of the month last week. Whichever the reason, last week's market movement did show signs of investors taking a little breather as S&P 500 and Nasdaq ended their 5-week winning streaks. But despite the rough week, it was still a winning month. In fact, it has been a better month for stocks than it has been historically. The Dow Jones went up around 1.2% and the S&P 500 was up around 3.6% last month. This is better than the average May performance for the indexes from January 1950 to April 2022. Well, personally, I would attribute the solid May performance to Nvidia and the usual few tech giants such as Meta, Google, etc. Notably, Nvidia ended the month close to 27% higher. Okay, so as we enter a new month and new week, what should we look out for? Well, corporate earnings are definitely winding down. Some notable companies that are reporting this week, which retail investors could be interested in, are Lululemon, CrowdStrike, and NIO. On the macro environment front, some investors may wonder how will the latest US political environment influence the market as the drama revolving Donald Trump's conviction on falsifying business records continue to unfold this week. In terms of geopolitical tension, President Biden said that Israel had proposed a ceasefire and he called on Hamas to agree to the new offer, saying it was the best way to end the conflict. Lastly, May's job reports will be released this coming Friday. The data will provide another indicator as to whether the Fed's monetary policy is restrictive enough to slow the US economy. For the last 6 months or so, jobs reports have often come in better than expected, though April was a surprise as it came in weaker than anticipated. So if history is any guide, it is possible that we will see the numbers beating expectations again. In case you're not aware, a strong jobs report with sticky inflation as seen from PCE's numbers could pressure Fed to hold the current interest rate longer than expected. And if ever Fed needs to do another rate hike, I think the stock market will not like it. Alright, let's move on to the next segment, technical analysis. Looking at the broader market, represented by SPY, things still look pretty decent despite last week's mini pullback. As you can see from the chart, SPY has broken out of this green dotted uptrend channel previously, came back to retest it and bounce off the channel line, before pushing towards a new all-time high. Right now, it seems like we are having this little pullback again, so don't be surprised if SPY hits towards the green channel line again at around 513. In fact, I wouldn't be too shocked if SPY breaks below 513 to fill that gap between 505 and 508. That is also where the critical 61.8 Fibonacci level is, and if I were to combine it with the gap area, we can call it a double support zone. In other words, I am expecting some form of bounce around this area if we ever get here, pretty similar to what we saw previously. But if SPY doesn't bounce from here, it means the broader stock market is bearish. On the other hand, if bulls start to take back control this week, then I think we could bounce off either at the 38.2 Fibonacci level or the 50 moving average, which ranges from 516 to 518. From there, if SPY can stay above 524, an area that it used to consolidate for 2 weeks previously, then it is a matter of time that we see another all-time high. Let's now hop over to Apple. Apple is looking bullish to me. As you can see, it has finally punched through the blue dotted downtrend line. Not just that, it did a classic retrace to retest the trend line and then bounce off it. If you have managed to ride the upside, congrats to you, but if you haven't, I wouldn't chase at the current level. Reason being, MACD had a bearish cross last week and we could see a small breather in Apple. If the pullback comes this week, we can expect Apple to retest the blue trend line again, as well as the Fibonacci level at around 185. If we have another bounce off this level, it means dip buyers keep stepping in and we could potentially push towards 196, which was the high of January this year. A break above 196, in my opinion, will almost certainly bring us to the current all-time high at 199, or perhaps even create a new all-time high. On the other hand, if Apple falls back below the blue downtrend line, then I think we stand a high chance to see Apple filling that gap between 173 and 180. That is one area that I may consider selling cash secure put, which is a slight bullish move. But before we even hit the gap, if the broader market is bullish, I would think the 200 moving average would serve as a strong support at around 180. It is only when this 200 moving average gets breached, then I dare say Apple's short-term trend is bearish. Alright, let's now check out Tesla's chart. In my view, Tesla is approaching a pivotal point. Reason being, Tesla has been consolidating for the entire month of May, floating between 168 and 185. As it consolidates, the Bollinger Band is squeezing. If you could recall what I have shared in the past, that is, when the B-band squeezes, it is typically followed by a huge movement. We saw this in the last 3 occasions. Back in April this year, the B-band squeezed and Tesla fell from 170's range to as low as 139. That's more than 20% decline. And then check out February this year. The B-band squeezed and Tesla fell from 190's range to low 160s, and that was a 15% drop. One more example. Back in December 2023, we had a B-band squeeze and Tesla fell from 240's range to around 170s, 180s range, and that was at least a massive 25% drop. Okay, before you think that Tesla is gonna drop 15% or more, hold on. Just to share, when Bollinger Band squeezes, the huge movement that follows after can be in either direction. It doesn't have to be towards the downside. Just that Tesla has been in this long-term downtrend. Therefore, the past few examples showed Tesla falling. But if you were to ask me, I think the probability of Tesla falling is higher than rising. Reason is because, first of all, it lacks strength to go further up after breaking out of this mini move lag. Secondly, we are heading towards the top end of this long-term blue dotted downtrend channel, and Tesla could face some resistance here at around 185. Thirdly, the MACD just had a bearish cross last week. Okay, I'm not trying to scare you, but if the B-band squeeze is towards the downside, don't be surprised if it falls towards the 150's range. That's more than 10% decline from the current level. But all that being said, I stand corrected. Technical analysis is not a prediction, it's all about probability. So the bearish thesis will be invalidated if Tesla can break free and break above the blue dotted downtrend channel. Which means Tesla has to go above 185. When that happens, I would think we will go close to 200 level. That again is a more than 10% move. All in all, if you are a Tesla bear and if you are buying put options, even if the odds may be in your favor, please have an exit plan or stop loss, just in case the trend goes against you. Don't forget, this is Tesla, anything can happen. Just to add, both the MACD and RSI are flat, and with the B-band squeezing, it's anyone's guess for the next direction. So for me, I am staying out of any short-term trades until Tesla shows me the next direction. Hopping over to Google. Google is on this impressive run that started since October 2023, as you can see on the chart where I drew a green dotted uptrend channel. On and off, it fell out of this channel, but somehow it still managed to get back in. As we zoom into the chart, you can see that Google attempted to break free from this channel again recently, but failed to do so as it fell back into the channel. Okay, if the broader market continues to be bearish this week, then we can expect Google to continue to fall towards the bottom end of the channel, and coincidentally, that is where the first Fibonacci support level sits, at around 167. This is one potential bounce area. But if Google doesn't bounce from here, things will get interesting, and I will be excited, because Google could head towards the big gap between 156 to 162. It may or may not fill the entire gap, it really depends on the market makers. Within the gap, two support levels to watch are around 160 to 162 area where the 50 moving average and the next Fibonacci level are, as well as the bottom of the gap, which is 156. Google has to bounce from either level or area, otherwise it's very bearish. The reason is because below that we are looking at 149 where the critical 61.8 Fibonacci level is, or even the gap at the bottom between 143 to 146. Okay, honestly, for Google to fall to this level, it does seem like a long shot. So let's check out the bullish thesis. If let's say Google bounces from either of the support levels that I mentioned, watch whether is it a fake bounce. How do we know? Very simple. As long as Google gets back or remain in this uptrend channel, we are good. If you want to tag a level to it, I would say 167. Anything above 167, Google has a chance to revisit the all-time high again. Alright, if you found this video useful so far or like my free content, do consider supporting this channel, which can be done through several ways. You can either buy me a super thanks on YouTube, a cup of coffee via my Ko-Fi link, or just simply comment something below. You can also tap the like and subscribe buttons, or perhaps share my videos with your friends. Well, so many options for you, do consider at least one of them, I would be really grateful. Let's now look at Meta's chart. Meta looks impressive since it had that post-earnings gap down, as it had recovered well and almost filled the entire gap. We are now left with a very tiny gap between 482 and 484. Well, I have shared a few times that market makers will likely not do things so precisely for you. So just when you thought Meta could fill the entire gap, the market makers started to take it back down a little bit. To highlight, the gap area is also where the 50 moving average sits, at around 482. This means we have a double resistance formed by the gap and the moving average. Therefore, no surprise that Meta gets rejected here. Just to add on, the MACD is on the verge of crossing down, and if it happens this week, we can expect Meta to fall below the support level of 452. When that happens, things will get interesting because the huge gap at the bottom could serve as a magnet to pull the stock down. The range of the gap is 400 to 414. Quick disclaimer, I'm not saying it will happen. Watch for the key support levels. One level is what I have mentioned, which is 452, while the other is the low of the post-earnings gap down at 414. If 414 breaks, I think there is a high chance for Meta to head towards 400. On the other hand, for Meta to resume its bullish momentum, quite straightforward. It has to break above this mini consolidation zone, and more importantly, go above the 50 moving average that I mentioned earlier, at around 482. Finally, moving over to Microsoft. Well, after being away for 3 weeks, it seems like Microsoft has been trading as per my previous video. In a nutshell, Microsoft is still trading sideways, moving between a range from 390 to 430. As you can see from the chart, while I was away, Microsoft went to the top of the consolidation zone, got rejected, and now it's heading back down. Come this week, don't be surprised if Microsoft continues to fall further. I think the gap between 399 to 401 will be a magnet trying to pull Microsoft down. What didn't help is that MACD just had a bearish cross last week, and what appears to me is that we have a bearish double top pattern. This signals simply mean the near-term downtrend could potentially continue. Caveat, I could be very wrong. Okay, let's say Microsoft indeed hits the gap area. That's one possible place for Microsoft to bounce. If it doesn't bounce, we still have a strong support at 390. That is the place which will get me excited to either pick up shares or to sell cash secure put as I anticipate a bounce here. But if it still doesn't bounce here, then Microsoft is very bearish because it's breaking below the consolidation zone that it has been stuck in for the last 4 months. On the other hand, in terms of the bullish thesis, if Microsoft bounces from the current level or bounces from low 400s after filling the gap, watch for 430, which is the top end of the consolidation zone. If Microsoft could test this level another time and goes above it, that is very bullish. Alright, moving over to the options trading segment, as I would want to be transparent and cover every single trade that I made. Therefore, I have quite a few trades to cover in this video since I was away for a while. So I have to go a little brief for each trade here, as in it will not be super detailed, pardon me, alright? Okay, the first trade to update is this covered call on Tesla with a strike price of 200 and the expiration date was 14 June. This contract was sold on 6 May and was meant to be a quick scalp. So what happened on that day was that I saw Tesla popping for no reason and it was hitting the top end of this green dotted channel, which means there could be some form of resistance. As a result, I stepped in to sell a covered call, which is a slight bearish move. By doing so, I receive a premium of $655. But this green channel is actually the flag of this bull flag setup, and if Tesla breaks above it, it can be very bullish and my 200 strike price could be breached. Therefore, shortly after I sold the call contract, I saw Tesla retrace a little bit, and so I quickly bought back the same covered call contract by paying $595. This means my net profit for this trade is $60 less the trading fees, and these two trades happen within 25 minutes. Well, $60 in half an hour, not a lot, but I will take it. Moving over to the second trade, it's another cover call on Tesla, and this strike price is 190 and it's set to expire on 21st June 2024. The trade was opened on 8 May and I received a premium of $535. The reason for this trade was because I think Tesla is currently lacking major positive catalysts to push the stock price higher. And true enough, since I sold the call contract, Tesla has been moving sideways for the next 15 or 16 trading days, which is around 3 weeks. Currently, the trade is sitting on a small profit. Come 21st June, if Tesla closes below my 190 strike price, I will get to keep the full $535 premium without having to close my position. But even if Tesla closes above 190, that is fine as well, because if you have been following me, you would know that I was being assigned with 100 shares of Tesla at 190 per share. So I am basically returning these shares to the market makers, while at the same time I still get to keep the $500 over dollars. Next is this cash secure put on Microsoft that was sold on 5th April 2024. The strike price was $390 and expiration date was 10 May 2024. There were a couple of reasons for making this trade. Basically, Microsoft has been consolidating between the range of $390 to $430 from late Jan to early April, and there wasn't any sign of breaking out of this consolidation zone. Furthermore, I chose $390 as a strike price because that is where the critical 61.8 Fibonacci level was, which means this level is not easy to be breached. And guess what? Microsoft did test $390 level and it bounced back up very nicely. It then continued to trade within this range of 390 to 430, and so on 10 May, Microsoft closed above my strike price, which means the contract expired worthless, and I got to keep the full premium of 270 without having to close my position. If you are keen to find out the full thought process of this trade, please check out the video link at the top. Moving on to the next trade, it's this cash secured put on Tesla that was sold on 9 April 2024. The strike price was 140 and expiration date was 24th May. This was a risky trade which I did highlight in my previous video. At that point, Tesla was trading around 170 range, and I saw two bullish signals, namely a little bullish double bottom pattern as well as a slight bullish divergence on the RSI. But this trade was labeled as risky because I did not wait for confirmation of the bullish momentum. And guess what? Right after I sold this put contract, Tesla fell the next day and continued falling to around 139, breaching my 140 strike price in the process. But then, this trade was saved by Elon Musk as he came out to excite the investors during the earnings call. As a result, Tesla flew from around 139 all the way to 198 in less than a week. Anyway, Tesla then went on to trade sideways, and on expiration date, it did not close below my strike price, so my contract expired worthless. The profit for this trade is around 205. For more detailed explanation of this trade, please visit the video linked at the top. Alright, the last option trade to update for this week is on Bank of America. So, I had this covered call on Bank of America with a strike price of $38 and was supposed to expire on 31st May. But on 28 May, 3 days before expiration, the stock was trading above $39, and I was of the view that the price was unlikely to fall below my $38 strike price in just 3 days, and so I decided to roll the contract. But why did I do that? Well, not because I really want to keep this Bank of America shares, it's actually because of its dividend. The ex-dividend date is on 7 June 2024, so I thought to myself, why not just hold the shares for another 1 or 2 weeks and I can get the free dividend from the company. It's not a lot, it's only 24 cents, which means $24 for 100 shares. In fact, after I minus off the tax, the amount is lesser. But to me, it's free money, just take it. And therefore, I wrote the contract to a further expiration date, which is 14 June, with the same $38 strike price. Come 14 June, if Bank of America closes above $38, so be it. I don't mind these 100 shares getting caught away. Alright, the video is a little long, so I will keep this portion short. Well, last week, the Fed's preferred inflation gauge came in without deviating much from expectations, and that only means two things, at least to me. First, inflation is not hotter than market expectation. That's good news. Second, inflation is still sticky. That's not so good news. Basically, they cancel out each other. This also means that it is very likely the Fed will hold interest rates at the current level during the upcoming FOMC meeting that is taking place on 11 and 12 June. But here's something that I would like to highlight. This coming FOMC meeting will provide an important update as to how the Fed is thinking about rate cuts in 2024. On 12 June, when the meeting concluded, Jerome Powell will update their very own projections for year-end interest rates, which would be an additional insight for the stock market. In case you're not aware, back in March this year, most FOMC members had forecasted 2 or 3 cuts this year. Given that inflation data has been somewhat sticky and lacking progress in moving towards Fed's 2% target, the market would want to see if there is any change in the forecast as compared to March. Meanwhile, personally, I think the market is lacking a short-term catalyst, and therefore stocks will continue to chop around a little bit but swaying towards the bullish side. This means we can expect small pullbacks along the way as the market continues to go higher, and these pullbacks are opportunities for investors to hop on the bull train, which is something that I have been sharing and doing myself, as I have picked up shares of Apple, Google, Microsoft, etc. over the last 3 months. Anyway, glad to be back to share my market analysis with you guys. If you like my videos, do help to share it with your friends and remember to tap the like and subscribe buttons. Thank you.